Welcome to TheoTrade. This is Don Kaufman. August 2nd, 2024. 30 minutes to go to the cash close here on this Friday afternoon, and it is game on, people. Volatility strikes back inside this marketplace. Let's get right to work here on this TheoTrade weekend update. So at this point in the trading session, S&Ps are down 110 handles. So we're off just by about 2%. Now, before I go any further than that, people are constantly commenting it's unprecedented volatility. Look, I get it. Volatility definitely took off. We're going to look at that in a moment. Like, we're going to look at VIX. Don't think we're not going to look at VIX, which ripped. We're going to look at VVIX. We're going to look at the vol futures. Let's get crazy. But before I really dig into any of that, I want to go to the SPX, often known as the mother of all products. And the reason I want to go to the SPX is just to give you a little bit of perspective of how much has changed, if you will, in, well, 2 trading sessions. For the most part, you have to recognize that yesterday, literally yesterday, the S&Ps were actually sitting at the upper edge of an expected move, right? Which is just north, okay, of approximately 55, we'll call it 60, right? Right in that neighborhood there. So the S&Ps were actually at the upper edge of the expected move. They reversed, okay? And they reversed to the tune, okay, of just over about 110 handles. Now, I just want to bring this up because the expected move in the SPX on the week was plus or minus, okay, roughly 104 points. And what you saw, again, the Fed came out, and the Fed didn't have much to say, and we'll talk a little bit about the Fed, but the market was already ripping on Wednesday. And in the Wednesday night video, I literally said the rally that we saw on Wednesday, for me, it just checked off the box, confirming it's about to get real, it's about to get big, it's about to get wild. You didn't know if that was going to happen on Thursday, on Friday, but you knew after, okay, the rip on Wednesday that vol was coming. And that was the entire premise, if you will. I mean, it was the signature, okay? It's the hallmark of volatility, is the quintessential rip your face off rally. So on Thursday, and again, I literally want to take this to an intraday 1-minute chart. On Thursday, we tagged the upper edge of the expected move to the penny. $5,560 product. We hit that thing to the penny. You just, again, if you're not following an expected move, okay, you shouldn't be in this business at this point. Look at this thing. Hits it to the penny. Okay. We reverse off of it. And all throughout the course of today's trading session, we've been flirting with the lower edge of the expected move. And the reason I said right off the bat, okay, look, volatility has definitely emerged. As I said, the volatility beast has emerged. Last weekend was, the volatility beast might be waking up, and well, it's here. But, okay, the big perspective, we didn't do anything outlandish. We didn't do anything that isn't, if you will, in the norm. Now, there's still 25 minutes left, and these S&Ps could break lower, and all of a sudden we crack outside the expected move. Let's get crazy with it. But right now, we're kind of just ebbing and flowing on the lower edge of the expected move. As I said just a moment ago, there's nothing unprecedented about that. The only thing I would say that's a little wild here, it's just the overall movement from high to low. I mean, come on, we're trading, 55.66 in the S&Ps. And we're literally, hitting 5,300 right now at, 53.35. Okay, you got me there. That's a little wild. Things got a little crazy for a moment, but we're not drastically outside the expected move. And I wanted to start with that because at a time like this, okay, sometimes you have to talk people off the ledge. And if that gives you a little perspective, like, look, you may have taken a hit if you were long, but the perspective is, this could have been a hell of a lot worse. And obviously, the marketplace is not over. It could have been a hell of a lot worse. And you can see some real damage now is being inflicted to the NASDAQ. And what's even more, I think, intimidating is not looking at the NASDAQ on a 9-month chart. But when you start to open up to like a 5-year, this happens to be a 5-year weekly, okay? All right, now you can see some damage inflicted. Look, we've seen substantially more than this before. Okay, that was, so was a down year. Okay, nevertheless, there's some damage starting to be inflicted, and even more intimidating is when you start to open up to like a 15-year. This is a 15-year in NASDAQ. Okay, you have to literally go, holy, think about that for a second. That's starting to become some damage inflicted. This is definitely a dent in the marketplace, no question about it. Now, let's start to talk about, again, things that we're going to be doing. All right, not just reading the tea leaves over here, but let's see how intense things got. And when I buy that, okay, we're going to look at VIX. Obviously, VIX ripped, almost hit the 30 handle, a little bit of an overreaction, possibly. Okay, but you got to be careful at this point because you have to recognize. You look back at like a 3-year in the VIX. It got up there. Now we're on the map, people. There's no question. We're on the map. Volatility is out there. So once volatility cracks open, the concern for me is not VIX. Once volatility cracks open, okay, I'll look at vol futures. We can talk about VVIX till we're blue in the face. In fact, yeah, sure, what the hell? We'll pull up VVIX even before the vol futures in here, right? Why am I looking at VVIX? Because I want you to know VVIX, okay, it's smashed above the 110. And that line, that 110, it's what I kind of call the VAMA zone. That just basically means you're in the throes of some serious volatility. Okay, end of story. After VVIX cracks that 110 region, it doesn't make a difference anymore. Who the hell cares? Volatility can be sustained for weeks after. After the VVIX cracks it, it's basically just a confirmation of all hell is about to break loose in the market or is breaking loose in the market. And yeah, we're kind of seeing a little bit of that. But as I said to you, things are still rather normal, and there's some bad things going on here, which I'm going to show you momentarily. What you want to focus on at this point, when it comes to volatility, forget about VIX. Okay, seriously, that's I say this all the time, but that's my predecessor's like volatility indicator. I'm going to freeze the screen for a second. Who freezes the screen when the S&Ps are down 120? I do. Check this out. Vol futures in the August timeframe are actually trading right now 21.95. Okay, and 47 days out in the SEP, they're trading 21.40. Welcome to volatility backwardation, where all hell could break loose. So the problem you've got right now is once the volatility futures do what we call an inversion, and they're inverted, that basically means, okay, that AUG is above, okay, SEP. And what that actually causes is anytime there's any sell side activity to the S&Ps, okay, the August volatility starts to take back off to the upside, and it forces trading firms to sell S&Ps. So S&Ps, okay, force vol to go up. Vol to go up forces more selling in the S&Ps, and we start to actually get into a very, very ugly feedback loop. That is something like, look, as long as this volatility, okay, is inverted. I don't like to use the terms like contango and backwardation because people don't know what the hell I'm talking about. Okay, as long as volatility is inverted, where front month is over, okay, the back month, okay, you got some issues. You got issues right now. There's no question about it. You got issues, and you better focus on that. All right, onward from there. So what to really look for? Well, I'm showing you right now. There's going to be rip your face off rallies, but the rip your face off rallies, what's going to happen during them now is volatility is just going to flatten out. Okay, it could take a while before volatility normalizes, but this is your part of the feedback loop at this point. All right, the next thing on here, what I would say is downright hideous. The bonds are full-fledged duck and cover. Now, I talked about this on Wednesday night's video, and if you didn't listen to it, you missed out. I told you guys on Wednesday night video, I was talking to traders, and I said, why are the bonds rallying? Okay, and every trader agreed with one thing. This has nothing to do with lowering interest rates. It has everything to do with duck and cover. They were ducking and covering on Wednesday before we ever sold off. The bonds knew before you knew, period. Okay, the bonds have exploded. At this point, okay, everybody that needed a hedge, they're all in over here. This is an absolutely stellar move. You got to go back years and you'll still see this move on the chart. This is a 5-year weekly, people. That is a freaking move. And I cannot stress it any more than that. When the bonds are screaming at you, duck and cover. And today, the one thing I would say about today's trading session, like, holy crap, the bonds are up, 2 and 20 ticks. Then I look at the S&Ps and they're not even down 3%. That doesn't leave me warm and fuzzy. And I can't stress that enough. I'm not warm and fuzzy right now. What I mean by that is not only the S&Ps, in my opinion, they don't look like they're getting hit hard enough. Volatility definitely raged. We inverted in volatility, but the bonds, okay, this is an angry marketplace. And I'm left like wanting more. Moreover, if I take a look at the correlation point of view, and that's my next point of view here, correlation, it's still not there. It's close. Oh, look, in the S&P 100. And again, I want to make sure that everybody understands what I'm talking about over here, okay? In the S&P 100, all right? That's supposed to say 100 in the S&P 100. I want to see like 95 stocks trading to the downside. I mean, I always call it like when there's like 95 stocks, I call it like a full court press. I want to see what I call nowhere to run to, nowhere to hide. Okay. People have to literally barf. That's what they got to barf the market. And you're nowhere near that. I mean, to me, there's 20 some odd other things you can sell over here. And some of these, I mean, look, okay, they're using, again, certain sectors defensively. There is no defense to a marketplace that's tanking. I'm going to say that again. There's no defense. All you can basically do is rotate, not to a sector, but to the bonds. Maybe rotate to volatility products. It's not right. I don't like it. I don't care. Like people are saying, are you selling puts today? Nope. Why? Because not even a 3% move. Are you selling puts today? Nope. Why? Because we're barely outside the SPX expected move. Are you selling puts today? Okay. No, I mean, the vol futures, the first day they've actually inverted. I mean, don't get me wrong. The Russell's getting hammered out there. Okay. Oh, that's a big move. But it's not there for me yet. It's just not there for me. I'm not saying that we're not going to rally right back. Okay. All right. I'm not saying that we're not going to rally, but I'm going to tell you right now, there is some damage, real damage being inflicted in this marketplace. And it's all in literally the last 2 days. So correlation's still not there. Now, here's where actually the economic news has been very interesting. In the last basically 24 hours, the last 2 days of trade, okay, not only have we seen bad economic data, some ISM numbers, some jobs numbers, obviously, that came out this morning, okay, but it's amazing because we're just a few hours of trading removed from the Fed, and the Fed was like, yeah, maybe we're going to lower in September. I mean, look, they kind of tipped their hat. They're probably going to like cut in September, okay? But now everything has changed because the jobs number missed to the downside. I think it was 114,000. I saw estimates as high as 175,000 in the jobs, okay? But who knows? The jobs could be revised. But oil bothers me because oil looks like it's starting to price in an economic slowdown, right? That's critical. That's a really, really critical, it's an aspect I think a lot of traders would actually miss, but this is signs of an economic slowdown. And the irony is, again, you're just, 3 days ago, we're actually high-fiving one another. Ooh, the Fed's finally going to cut and things are not that bad. Well, guess what? Fed's going to cut and things are looking like, hell in a handbasket in the last 2 days of trade. Now, I will say this, finally, and this is critically important as well. Finally, bad data is bad for the markets. I have said this for years. That needed to happen. Bad data has to be bad for the markets, like ISM numbers, durable goods, okay, factory orders. Stuff comes out, okay? You have to take bad data as bad for the markets. All we're listening to right now is the data hasn't really mattered all that much, just been a catalyst. But if you look at stuff now, well, Amazon, okay, yeah, that happened. Amazon actually took a big hit. There's a couple of big hits throughout the course of the week. Everything in tech, okay, that actually was negative was playing out specifically inside of NVIDIA. And I've said this 100 times. NVIDIA is the stock that actually got us here. Got us where? Got the NASDAQ above 20,000. Okay, and NVIDIA is the stock that's actually taking us apart. Don't forget it, because when you look at NVIDIA now on a year-to-date percentage, you did have a stock that was up 190%. I said this the other day. Okay, now is only up 120%, right? And you look at that, you're like, yeah, but it's still up 120%. Exactly. And that should be more of a fear to you, okay, than a positive, because the decline in here, right? If you look at this on a percentage basis, right, the decline in here, it's big. I mean, the thing has lost a quarter of its market cap. It is now, I believe, back to right around a $2.5 trillion company. But still, my heart, it's only worth 2.5 trillion. Okay, 2.6 trillion. It actually bounced a little bit in the last hour or two over here. Nevertheless, okay, NVIDIA continues to actually take hits, and that is impeding upon the broader marketplace. So oil pricing is slow down. Obviously, bad data is bad for the markets. Now, let's spin around to something very interesting. the Fed cut, okay? So right now, we just had a Fed meeting. The Fed, I mean, in my opinion, said absolutely nothing. And again, people think that the Fed caused the rally the other day. And I want to really clarify, all right, just that. Did the Fed really cause the rally on Wednesday? So that Fed meeting was late in the trading session, very late in the trading session. By the way, you're looking at a 30-day 1 hour. If I just highlight specifically into Wednesday, when did the Fed actually come out? I'm in Pacific time. Fed came out in this neighborhood here. Okay, great. Rally actually was on well before that. So the Fed literally had nothing to do with it. Okay. What's interesting about the Fed at this point is, again, I take everything they say with a grain of salt, but this is interesting. Okay. What you're looking at right now between the August and September meeting is the longest time frame that we go without a Fed meeting. So now you got to wait till September 18th for the possibility of a cut. There's already, you got to understand, the Fed just came out Wednesday. There's already rumors right now the Fed may have to do an emergency interest rate cut. There's already rumors floating around. Okay, is there any truth to it? Absolutely no idea. But there's already rumors floating around there's going to be an emergency interest rate cut. The other really crazy thing, this was like 4 or 5% the other day. What's this? Okay, current Fed rate is 525, 550. Now we're pricing in the September a 50 basis point cut. So not that there's a 100% chance of a cut. There's a 73% chance that it's going to be a 50 basis point cut. And I'm just going to throw this out here, okay, for your own consumption and for your own knowledge. Okay, in my personal opinion, it's just my personal opinion. If the Fed comes out and does an emergency interest rate cut, markets will absolutely crater. They will panic. That must mean the economy is definitely worse off than we had anticipated. Forget about inflation. Nobody gives a damn. It's going to be a complete free-for-all. That is not something we want to see. I think the Fed should sit back, possibly wait for data to come out. But okay, the other aspect is if they do a emergency cut, would actually indicate that the Fed is late to the game and actually a policy mistake is underway. So at this point, again, my opinion, the Fed's actually going to sit tight to the September 18th meeting unless more data comes out that's just absolutely horrendous. Now, those Fed cuts, they could come a little bit too late. Now, the other aspect I wanted to bring up with this that definitely had an effect, at least on the way that I am thinking about markets right now. So there's a flight, okay, to some quality, which is, they're buying bonds and so forth in the midst of some volatility. They're not, by the way, traders are not buying crypto. They're not buying Bitcoin as a flight to quality. That's critical. For those of you that are actually crypto traders, it's not working the way that people perceived. In fact, okay, I'm going to argue that Bitcoin actually could take a dramatic hit if the S&Ps continue down because people will liquidate, all right, their Bitcoin to actually cover other margin issues. Remember, Bitcoin now is traded pretty much seamlessly in most trading applications where you can actually trade Bitcoin futures, you can actually trade physical, crypto on some platforms along with stocks, options, and futures like platform like Tasty where it's all seamless and front to back, right? So with that being said, crypto is actually reacting negatively right now with markets down. So I was also bringing up another aspect here in Japan. Okay, so first of all, the Japanese yen is exploding back to the upside. Okay, which, all right, we saved it. We saved our currency. But I don't say this and I don't take this lightly. The Japanese markets have officially crashed. So the Nikkei is down, not just a little bit at this point. The Nikkei on a year-to-date basis is still up about 8%. But the most recent decline here, and you have to look at this from absolute high, you zoom in, the absolute high to where we presently are trading, okay? Market's down about 15%. That actually transpired literally in the last 3 weeks, okay? In the overnight trade, when the Nikkei actually was open, it dropped to the tune of almost 6%. It's one of the most serious markets around the world. German markets down about 2.3%. That is much in line, okay? Much more in line with what we're seeing here in the US, okay? But that definitely has a little bit of fear, okay, in the trade. All right. So last thing I want to talk about, of course, is the SPX and really where to go from here. In the SPX, so as I said earlier, we had this $104 move. And by the way, right now, S&Ps, just since I actually started recording this, and again, there's about, a couple minutes left, S&Ps have actually reverted back down. They look like they're going to get tagged That is sell side activity into the close. Looks like it's going to be heavy sell side activity into the close. Okay, so we're going to close outside the expected move, which is getting a little bit more interesting, but we're still not at that, for me, that quintessential 3%. So the S&Ps are getting hit a little bit. The SPX is going to close, it looks like, outside the expected move. Now here's something, okay, that is a little bit daunting. We just had big earnings that came out. Everybody's aware, like Apple did a little dance, made a little love, got down tonight. Apple's basically flat though on the day. Amazon got hammered. We saw the likes of like Meta. By the way, Meta, okay, wow, that thing is getting smoked from some of the highs. Anyway, Nvidia taking a hit over here. Even Tesla getting rocked once again. I believe Tesla's down like 16, 17% now on a year-to-date basis. Okay, back to the SPX. What is a little bit scary at this point? 7 days out, and again, I'm going to freeze the screen even with minutes to go into the trading session. Look to the August 9th, okay? You're looking right now in the neighborhood of about 140, okay, to $150 expected move. This is not set in stone. It's going to fluctuate, okay? I take expected move readings 15 minutes after the cash close. 15 minutes after the cash close, the SPX closes. We're at about $143, which is approximately a 40% increase, and it's not set. Now it's almost 45. It's a 40% increase, basically, in risk. That is a significant number. It's a very significant number. We're actually looking throughout the course of next week, riding on like a 24 vol. You got to keep that in mind. Why? Okay. Well, with $140 some odd expected move. Okay. At this point, yeah. What am I doing right now? I'm looking to fade bounces. And I want to make that clear. I am looking to fade bounces, right? I did it on Wednesday. Actually shorted into Wednesday, that, rip and rally. Okay, on Thursday, we actually peaked, came off huge, and it has been spectacular. The other aspect I'm looking for, and I am going to be very reserved in doing this. Talked about this also extensively. We're all volatility starved animals, okay? You don't jump in, okay, at the first sign of some risk. Let this play out a little bit, because I'm going to tell you right now, this very well could turn into one of the most serious markets that you've been in, okay, in years. This is a marketplace, and again, I want to kind of finish with this, a little finale, if you will. You're in a marketplace that has been incredibly one-sided. No, not for 9 months. This is a marketplace that has been influenced, okay, time and again by the Federal Reserve. Federal Reserve at this point, interest rates are up there. They can definitely cut them, okay? Could be too little too late. But at this point, contracting liquidity is going to be critical. The Fed can't step in and start pumping liquidity, or they'll immediately, okay, start to jack up the inflation again. You can look at a 15-year chart. You can look, okay, at, again, this is a max chart on here. You're going to see some damage now into this marketplace. It could be one of the more serious times of this marketplace and in recent history. Does that mean it's turning into, a little bit of a crisis? Absolutely not. Not yet. Too early to tell, okay? But you don't jump in here at the first signs of risk. As I reiterated, look at this. Right now, we're trying to catch the lower edge of the expected move. And what that tells me, things, okay, they're starting to come apart a little bit at the seams, but we're not unruly. Okay, what's going on right now? Hey, we're still very, very methodical. Things are very, very orderly. I believe you need to see some, irregularities. Markets really got to break down. You got to feel pain before any of this is going to be over. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.